Well, welcome back to Financial Accounting, and we're going to be beginning an analysis. We're going to be beginning a new chapter here, which is Chapter 7, which is accounting for long-lived assets, intangible assets, and natural resources. So you can see here that I got my camera back. Good evening, everyone. Quick trip to the dentist here on Halloween. So we're going to take Chapter 7, and we're going to cut it into 3 parts as we normally do. And our focus is long-lived fixed assets, intangible assets, and natural resources. And as far as the difference between each of those 3 things, that'll become clear as we hopefully come clear as we go through parts A, B, and C. First, the first takeaway or first learning objective we're going to do here is to describe how the acquisition costs of a long-lived asset. So not to give away the whole story, a long-lived asset is something that lives for a long time, and how the accounting treatment for ongoing costs related to these assets differs. So we've got the cost of, say, a building, or a cost of an airplane, or cost of Carnival, and my heart goes out to them now with this. They haven't been sailing for several months, and just imagine someone who would still be looking for a smack to do might want to do the impact of COVID on the cruising industry. I imagine their financial statements the last couple of quarters have been devastating. So we've got the cost of, if you're Carnival, of the cost of buying the ship, and then you've also got the cost related to the ongoing maintenance of the ship and improvements to the ship and so forth. So we got to figure out how much how to record the cost of those ships, and how to account for the ongoing costs of operating that, and how the costs can differ between. Going to have to figure out if we have a maintenance cost, is that a normal maintenance cost, or is that something that's actually going to be what we call a betterment, because it's going to extend the useful life of the asset. So let's begin here. So capitalized cost of a long-lived asset. So that's first thing we got to ask ourselves is, what is the cost of the asset? And the cost of the asset, a good rule of thumb there, is it includes the cost necessary to get the asset installed for the purpose I purchased it for. I learned that many years ago in my first accounting course, and it's true to this day. We also have the costs after we acquire the asset. We have betterment and maintenance. So maintenance would be the costs incurred to keep the asset going. You know, the cost of oil changes, maybe painting it each year and stuff like that. That would be a maintenance cost. But we also have costs that are called betterment, and these are costs that may seem like maintenance costs, but they actually extend the useful life of the asset, and we're going to call those betterment. Anything that's treated as a betterment is going to show up on the balance sheet. So newly acquired long-lived assets are capitalized. Again, anytime you hear capitalized, that means it shows up on the balance sheet. So it's going to show up at the balance sheet at its acquisition cost. So one of the first things you're going to do in problem 734 is you're going to try to figure out what to include in the acquisition cost. So the acquisition cost of an asset, again, all those costs necessary to get the asset installed for the purpose I purchased it for. So general rule of thumb, all costs necessary, this is the author's words, not mine, any transportation costs, any special training costs, any cost that you have to get that asset into its revenue producing state. Sales tax, transportation costs, specialized employee training, if you got to train the employees on the new asset, and any modification to the buyer's facilities to install this thing, all become part of the acquisition costs. So there are other costs that are capitalized. So if we build an asset ourselves, classic example of this would be the automobile industry. They retool their assembly lines every 3 to 5 years, and rather than hiring someone to do that, they do that themselves. So the costs of rebuilding the assembly line are going to be capitalized. And when they do this, if they finance this, any self-constructed asset, under US GAAP, they get to capitalize part of the interest cost. So if they have to borrow money to finance the operation to rebuild the assembly line, then they get to capitalize the interest. The amount of interest that they capitalize has got to be disclosed, however, in the financial statements, in the notes. So that enables analysts to say, oh, gee, what would this company's results have been if they hadn't capitalized the interest? Here's a difference between US GAAP and international GAAP. In international GAAP, company has the option of either expensing their interest costs for self-constructed asset or capitalizing. US GAAP requires that those costs be capitalized. And we want to disclose the amount of the interest expense we have here to enable the financial analyst to go in and perform their magic on the financial statements. Financial analysts would generally treat interest as an expense, so they want to be able to back it out of the amount company would have capitalized under US GAAP. So what about those costs that relate to the asset's use? So we've got the general maintenance costs, like oil changes, annual repainting. And then we've got what we call betterment expenditures. These are things that actually extend the useful life of the asset. So an example here would be a new roof on a factory, a new motor in a truck. In the case of Carnival, maybe it's a new propulsion system or a new air conditioning system. Probably, they probably had to upgrade significantly. If and when they get back in business, they probably had to make a major investment in air purifying technology. So that would be an example of what we call a betterment and betterment expenditures. If it makes the criteria of a betterment expenditure, it's going to show up not on the income statement as maintenance, but it's going to show up as part of the cost of the asset to be appreciated in future periods. So these betterment costs are frequently material, and they must be capitalized as an asset and appreciated over the remaining life of the asset. All we need to do is meet one of these criteria. Does it extend the productive life of an asset? If yes, capitalize. Does it improve the quality and quantity of an asset's output? If it does, capitalize. Does it reduce operating expenses associated with the asset? Yeah. So I don't treat, I do have my own business. I don't treat my house as an asset in that business. But if I did, I recently decided to put solar panels on the roof. And my rationale was that was going to significantly increase my utilities costs going forward. So I could have made a case for if I had my home as a business asset, then that would have made a classic case there of a betterment cost with putting in the solar panels. So if you put it on the capitalize it, it's not going to immediately reduce earnings. You're going to recover the cost in future depreciation expense. All right, takeaway 2 or objective 2, understand why the matching of depletion, amortization, and depreciation, depletion, amortization, that's an expense, why it's important. What is this, a long objective here? And how depreciation is calculated. We're not going to get to how to calculate depreciation in part A. We'll get into that in B, but we will differentiate between these different types of costs, depreciation, depletion, and amortization, and get into some of the assumptions that we have to make when we cover the costs of assets. So long-lived assets. So again, we've got depreciation, we've got depletion, we get amortization. We've got to come up with a way of allocating the costs of these long-lived assets over their useful lives. And we got 3 methods that you're responsible for: straight line, accelerated, and production-based. So don't be surprised when you get to problem 734, where you have an opportunity to apply your mastery of all 3. And we got different categories. So tangible assets, such as property, plant. Tangible means they have physical substance, so we call that a fixed asset. Intangible assets, they're soft, they don't have physical substance, but they have value. So it could be research and development costs under international GAAP, could be certain marketing costs, could be goodwill. We'll get the definition of that later on. Could be intellectual property rights. So somebody owns all the rights to the Michael Jackson songs, so that would be an example of a copyright. And our patent. So I'm looking here at my ThinkPad here that's got Intel inside, so there's lots of pieces of equipment in there that are covered by patents, which gives a company exclusive right to use that technology. Those would all be examples of intangible assets. And we have natural resources. So timber, oil and gas, iron ore, coal and uranium mines. So I've been a shareholder at ExxonMobil for many years. One of my nieces works there. Stock hasn't been doing well. I think my niece told me I should have sold it when it hit a certain $75. I don't even want to look at what it is right now. But ExxonMobil is one of the largest oil companies in the world. So they have a massive investment in oil under the ground that they have to account for. So that would be owning the rights to oil under the ground, owning the rights to a forest, owning the rights to coal companies in Pennsylvania, uranium companies in Colorado, iron wherever they mine. I think they mine iron in Minnesota. So those would all be, if you own the rights to those things, those are all examples of what we call natural resources. So we want to match the costs of the long-term assets against the revenues that they produce. So we could do this over time. We want to do it over the period of time that the asset is productive. We've got to come up with a method that is logical and systematic. Logical, for my Star Trek fans, Mr. Spock would always say, hey, that's logical, Jim. You did everything on the basis of logic. It's got to be systematic, which means we've got to be able to have a system that can rep someone else, 2 people doing the same thing using the same assumptions, we get the same answer. And allocation schemes, when I worked with Two Frost and I worked with my colleagues in the UK, they kept talking about all these schemes that they had. I said, my God, these people sounds like a bunch of criminals. So schemes in accounting is just a different approach. So we're going to have different methods to logically and systematically allocate the cost of these long-lived assets, again, over their useful lives and offset the expense of these assets against the revenues that they generate. So for the fixed assets, as opposed to the broken assets, fixed assets, we're going to recognize depreciation. The intangible assets, we're going to have amortization. The natural resources, we're going to have depletion. So you may recall from our study of the statement of cash flow, and I hope you enjoyed those 2 questions I gave you on the midterm about cash flow. These are non-cash expenses, but they are expenses nonetheless on the income statement. So depreciation, amortization, depletion are all going to show up on the income statement. So our purpose is to match the cost with the revenue generated by using the asset. It's not, I repeat, not, and for a third time, it's not to come up with the market value of the asset on the balance sheet. Remember that when you do discussion question 7.4. Our purpose here in recording things on the balance sheet is what we paid for them and how much of the cost of what we paid for we've recovered. We're not attempting to capture the market value of the assets. Okay, that's a little bit different under international GAAP. We'll get to that later on. And depreciation is not a source of fund of money. So just because you've recognized depreciation and you've got accumulated depreciation, that doesn't mean that there's a pot of money available to buy new assets. Right? So depreciation results in the same total over the asset's useful life. So regardless of what method you chose, unlike that Robert Frost poem about the guy walking in the woods, the route he took made all the difference. Not so with depreciation. If you're depreciating an asset over 3 years, then the total amount of depreciation you're going to recognize over the 3 years is the same. Your choice of a method is just going to give you a different answer each year. So management needs to make decisions. They need to choose a method. They need to choose a useful life. And a useful life in this context is not a personal statement of how well we've led our life. It is the useful life that when we buy a fixed asset or a natural resource or an intangible asset, what is the period of time that asset is useful to us? So Singapore Airlines, for instance, their whole marketing scheme was they used to fly the newest airplanes. So they may say their policy is that they're only going to buy a new plane, only going to use it for 10 years. They may just sell it to another airline, uses it for another 20. So if an airplane has a useful life of 30 years, the useful life for Singapore Airlines is a shorter period. Salvage value, that's the period of time, that's the amount that we estimate the asset is going to be worth when I'm done using it. And most companies of all these different methods, and I'm going to show you all 3, actually I'm going to show you a 4th one called macro depreciation. For financial reporting purposes, most companies use straight line. So you might ask yourself why the most company used the straight line method. Well, it's called straight line because it gives you the same depreciation expense each year. Depreciation is one of the largest operating expenses, and being able to hold this stable is very useful for forecasting purposes. And if the company is constantly buying new assets, and that's an assumption, but if the company is constantly buying new assets, straight line will give you less depreciation total than the other methods. But that's an assumption. If they're always buying new assets, depreciation will always be smaller if they use straight line. So I told you I was going to show you a slide that would show you a bar chart in terms of which one is the most popular. You already know the one that's going to be the most popular is straight line. So this graph is a little bit funky the way it's set up here. So I would only pay attention to the height of these things because they're showing straight line is more than 100%. That's not quite right. But the moral of the story is the vast majority of companies use straight line. Then you've got accelerated methods, which would be double declining balance or some type of declining balance. They accelerated not disclosed. So they used accelerated, they didn't disclose it. That's an interesting one. Followed by units of production, and then followed by our friend declining balance. And you got units of some of the years digits is kind of a permutation of declining balance. And then you've got something called the group or composite rate. So straight line is by far the most popular. And that was a poll of Fortune 1000 companies, probably from a publication called Accounting Trends and Techniques. So there's also macros depreciation, and this is not for GAAP, this is for tax purposes. Remember, the purpose of the tax law is not to match costs and revenue in accordance with generally accepted accounting principles. It's not to produce financial statements that are useful for people making decisions about the company. So macros depreciation is the depreciation that you use for tax purposes. And so you wonder where macros come from. That's modified accelerated cost recovery system, which ought to tell you that the tax system is accelerated. They get to, it's an accelerated method like the declining balance would be. And that would be what we call macros depreciation. Okay, and actually what it does is it restricts, it actually gives you a table and tells you the period of time you're supposed to depreciate the assets and what percent you're supposed to use each year. It actually maps out what the useful life should be. So that most companies, they're given a choice, either use macros or use straight line. Most companies will use macros because it gives them the largest deduction for tax purposes. Now here's an interesting case, one of many, where a company can use one method for financial statements and another for tax. So they use macros for tax, they use straight line for financial reporting. And tax law is designed to raise money and also to encourage people to do some things and discourage them from doing others. So by giving companies the incentive of writing off the large cost of the asset, largest part of the asset in the early years, that's an inducement for them to buy new assets. So as far as calculating the depreciation expense, we got straight line, we got declining balance, we got units of production. I'll show you how to compute these when we come back in part B of this lecture. So I'm not going to stop here, just add a couple of other things here. So if you look at these things graphically, if we were going to be depreciating asset over a 5-year period, so this is why it's called straight line. The depreciation would be the same each year. Accelerated method, we're going to use declining balance here. You notice the bulk of the depreciation is recognized in the earlier years. And then we've got production-based methods. So here we're basing the life of the asset not on the number of years, but how much the asset is actually used. We'll measure it, say, in hours or miles. And notice here, the depreciation each year is going to vary depending upon actual usage. So let's take a stop here. Stop sharing. And come on back for part B. See you shortly.